The sell wall just collapsed. Sure, banks panic as silver hits $80. The sell wall just collapsed. Banks panic as silver hits $80. For 40 years, they held the line. Every time silver threatened to break free, the wall appeared. Institutional sellers, coordinated margins, regulatory interventions. The barrier at $80 was supposed to be unbreakable, but on a single trading session, it shattered. Now, the world's largest banks are going silent. Derivative books that were profitable yesterday are hemorrhaging today. And the question no one in the financial press is asking, if they couldn't hold silver at 80, what else can't they hold? Welcome to Financial Inspection. If you've been following markets long enough to remember when interest rates actually meant something, when a handshake sealed a deal, and when banks feared regulators instead of owning them, then do us a favor. Hit that subscribe button, not for algorithms, but because serious economic analysis shouldn't be drowned out by financial entertainment. And tell us in the comments, where are you watching this from? New York, London, Singapore, Mumbai? Because what's happening in silver markets right now respects no borders. Let's begin. On the morning of the breach, traders across 3 continents watched their screens in disbelief. Silver had done something it was never supposed to do. It crossed $80 per ounce, and it did not look back. For anyone who understands commodities markets, this was not just another price movement. This was a structural failure. A sell wall, in the language of traders, is an invisible ceiling. It represents the price level where large institutional sellers coordinate their actions, where exchanges raise margin requirements, where the market itself seems to conspire against further gains. Silver had such a wall at $50 in 2011. The metal came within 20 cents, then collapsed 40% in 5 days. Someone, or something, made sure it did not cross that threshold. The $80 level was supposed to be even stronger. Banks had positioned their derivative books around this assumption. Mining companies had sold forward production at prices below 80, believing it was safe. Central banks had leased metal into the market, confident the ceiling would hold. And then it failed. The breach began in Asian trading hours. Volume was normal. Nothing suggested what was coming. But at 3:47 a.m. London time, a single order hit the market. 12 million ounces, bought at market price. No limit order, no negotiation, just raw buying power. The price jumped $4 in 90 seconds. Sell orders that had been stacked at $78, $79, $80 were consumed instantly. By the time New York opened, silver was trading at $83. And the real panic had not even started yet. Futures exchanges responded first. The CME Group, which operates the primary silver futures market, faced immediate pressure. Traders holding short positions, those betting silver would fall, were now facing catastrophic losses. Margin calls went out within hours. A margin call is a demand for more cash, more collateral, proof that a trader can cover their losing position. For every dollar silver rises, short sellers lose money on every ounce they have sold. At $80, many institutional desks were already underwater. At 83, some were facing insolvency. The exchange had 2 choices: let the market run and watch several major trading firms collapse or intervene, raise margin requirements, and try to slow the momentum. They chose intervention. Margin requirements increased by 40% in a single announcement. In normal markets, this would have worked. Traders would be forced to liquidate positions, selling would increase, prices would stabilize. But something different happened this time. The selling never came. In the physical market, a parallel crisis was unfolding. Physical silver, the actual metal bars and coins, began trading at premiums never seen before. Dealers in New York reported premiums of $12 per ounce over the spot price. In Singapore, premiums hit $15. This meant people were paying $95, even $98, for metal that was officially trading at 83. Why? Because they could not get it any other way. The paper market, the world of futures and derivatives, claimed there was plenty of silver available. But when buyers actually tried to take delivery, to convert their paper contracts into physical metal, they encountered delays. 4 to 6 weeks became the standard answer, then 8 to 10 weeks. Some dealers simply stopped taking orders altogether. Mining stocks responded with violent upward moves. Companies that extract silver from the ground saw their market capitalizations double, then triple in 48 hours. But even this reaction carried a warning. These stocks had not moved in anticipation of higher prices. They moved in reaction after the breach had already occurred. This told experienced analysts something crucial. The insiders, the people who run these companies and understand supply dynamics, had not seen this coming either. If the mining executives were surprised, if the bank trading desks were caught unprepared, if the exchanges were scrambling to contain the damage, then this was not a planned move. This was something breaking. By the end of the first week, silver had settled at $79. A pullback, but not a collapse. The sell wall had failed to hold at 80. And now, the market faced a new reality. If the institutions could not defend $80, what price could they defend? And more importantly, what happens when the world realizes there might not be enough physical silver to cover all the paper promises that have been made? The banks went silent. No statements, no reassurances, no explanations. Just silence. And in financial markets, silence is never a good sign. There is a photograph from January 1980, rarely discussed today. It shows the trading floor of the New York Commodities Exchange. Grown men, seasoned traders who had seen market crashes and recoveries, standing frozen. Silver had just hit $50 per ounce. Their faces showed something beyond shock. They showed fear, because they knew what was happening was not supposed to be possible. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, had done something audacious. They had tried to corner the entire silver market, not manipulate it, not influence it, corner it, meaning own so much physical metal that they could dictate any price they wanted. For 18 months, their strategy worked flawlessly. Silver climbed from $6 to $10 to $20 to $35 and finally to $50. Banks screamed for intervention. The government listened. On January 21st, 1980, the CBOT and COMEX changed the rules mid-game. They announced Silver Rule 7, a regulation that prohibited new long positions in silver futures. Traders could only sell, not buy. Within weeks, silver collapsed from $50 to $11. The Hunt brothers lost billions. They declared bankruptcy. The market, officially, returned to normal. But here is what the textbooks do not explain. Why did silver rise in the first place? Yes, the Hunts were buying aggressively, but individual buyers, even billionaires, cannot move an entire global market alone. The truth is darker. The 1970s had destroyed confidence in paper currency. Inflation was running above 13% annually. The dollar had been severed from gold in 1971. Oil prices had quadrupled. People were not buying silver because the Hunts told them to. They were buying silver because they no longer trusted anything else. The Hunt brothers were simply the most visible participants in a much larger crisis of monetary confidence. When the government crushed the Hunts, they were not just punishing two speculators. They were sending a message. Do not abandon the dollar. Do not seek alternatives. Do not question the system. Fast forward to April 2011. Silver reached $49.80 per ounce. This time, there were no Hunt brothers. No single entity to blame. Instead, millions of individual investors across dozens of countries were buying simultaneously. The internet had democratized access. A teacher in Ohio could buy silver coins online. A programmer in Bangalore could trade silver futures from his laptop. A retiree in Munich could invest in silver ETFs with a single click. The market had changed structurally, but the response was identical to 1980. Within 5 trading days, the CME raised margin requirements 5 times, not once, 5 times, from $9,000 per contract to $21,000 per contract, a 133% increase in 5 days. The message was clear: silver would not be allowed past $50. The price collapsed to $26 within 3 weeks. Billions in retail wealth evaporated. Forums and chat rooms filled with accusations of manipulation. But nothing changed. The system had held. Until now. What makes the $80 breach different is not the price level, it is the context. In 1980, the government could credibly claim they were stopping market manipulation. In 2011, they could justify it as volatility control. But in 2024 and 2025, what is the justification? Global debt has exceeded $300 trillion. Central banks have printed more money in 4 years than in the previous 40 combined. Inflation has returned, not as a temporary phenomenon, but as a structural condition. Trust in institutions, in currencies, in government promises has eroded to historic lows. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively building payment systems that bypass the dollar. Saudi Arabia, America's most critical Middle Eastern ally, is now accepting yuan for oil sales. Even domestic American citizens are diversifying out of pure dollar exposure. This is not speculation. This is survival instinct. And here's the critical difference from 1980 and 2011. In those years, Western central banks controlled the gold and silver narrative. They held the physical reserves. They set the trading rules. They determined what was legitimate price discovery and what was manipulation. Today, that control is fractured. China is the world's largest silver consumer, not the United States. India imports more silver annually than the entire Western world combined. Russia has been stockpiling precious metals for a decade. When silver broke $80, it was not Western institutions buying. It was Eastern central banks, sovereign wealth funds, and Asian manufacturing conglomerates, entities that do not answer to the Federal Reserve, entities that do not care about margin requirements set in Chicago, entities that want physical metal, not paper promises. The pattern is unmistakable. 1980, silver hit 50, and the system intervened. 2011, silver approached 50, and the system intervened. 2025, silver breached 80, and the system tried to intervene, but this time, the intervention is not working. Because the crisis is no longer about silver, it is about what silver represents, a vote of no confidence in the entire monetary architecture. And votes, once cast at this scale, cannot be retracted. There's a vault beneath Manhattan, 80 feet below street level, encased in bedrock and steel. It holds approximately 7,000 tons of gold. But here is what most people do not know. That physical gold represents less than 3% of the gold traded globally every single day. The other 97%, it exists only on computer screens. Paper gold, digital gold, derivative gold, promises to deliver metal that may not actually exist. And if this sounds troubling for gold, for silver, the situation is exponentially worse. A derivatives trader at a major London bank once explained it this way: "We sell promises, not metal." His desk handled silver derivatives worth $12 billion in notional value. Notional value means if every contract were exercised simultaneously, the bank would owe $12 billion worth of physical silver. That sounds manageable for a major institution, until he revealed the next part. The bank held physical reserves to cover less than 4% of those promises. 4%. Meaning, if just 5% of contract holders demanded actual delivery, the bank would default. But that never happens, he explained. These are cash-settled contracts. Nobody actually wants the metal. And for 20 years, he was right. Until August of this year, when delivery demands began exceeding supply by ratios never seen before. The mathematics of derivative exposure are simple, but devastating. A bank sells a futures contract, promising to deliver 1,000 ounces of silver at $70 per ounce. If silver stays below $70, the bank profits from the premium. But if silver rises to $80, the bank loses $10,000 on that single contract. Now multiply that by hundreds of thousands of contracts across dozens of institutions. At $80 per ounce, preliminary estimates suggest derivative losses across the banking sector exceed $40 billion. At $90, that number doubles. At $100, certain institutions face insolvency. Not stress, not difficulty, insolvency, complete failure. And this is where the contagion pathways emerge. Banking regulators operate under something called stress testing. They model what happens when markets move against bank positions. They simulate stock market crashes, bond defaults, currency collapses. But there is one scenario they almost never test adequately: commodity delivery failures in precious metals. Why? Because for 40 years, it has not been a realistic threat. Central banks suppressed gold and silver prices through leasing arrangements. Exchanges controlled volatility through margin requirements. The paper market always had enough liquidity to prevent physical delivery demands, until now. The London Bullion Market Association, the LBMA, is the epicenter of global precious metals trading. Every day, approximately $20 billion in silver changes hands through LBMA member banks. Most of this is unallocated metal. Unallocated means the buyer does not own specific bars. They own a claim, a promise, that metal exists somewhere in the system. It is efficient, it is liquid, it is profitable, and it is built entirely on trust. Trust that when someone wants to convert their paper claim into physical metal, the metal will be there. But in September, something unprecedented occurred. A mid-sized Asian sovereign wealth fund, managing approximately $8 billion in assets, demanded physical delivery of their entire silver position, 140 million ounces. The LBMA banks responded professionally. Of course, delivery will take 8 to 12 weeks. The fund's manager asked a simple question: why 12 weeks if the metal is already allocated? Silence. Then a revised timeline. 16 weeks to ensure quality assurance. The fund withdrew their request, but they also withdrew their trust. Within 30 days, they had exited every paper position in precious metals and bought physical metal, stored outside the Western banking system. This is how systemic failures begin, not with explosions, but with withdrawals, not with panic, but with quiet exits. One sophisticated player realizes the music has stopped. They remove themselves from the game. Then another player notices and follows, then 10 more, then 100. And suddenly, what seemed like unlimited liquidity evaporates. History offers a perfect parallel. In 2008, Bear Stearns was a fully operational investment bank on a Monday. By Friday, it had collapsed. Not because their assets were worthless, but because counterparties stopped trusting them. When trust disappears in modern finance, institutions die in days. The same mechanism now threatens the precious metals derivative market. Every major bank trading silver derivatives has counterparty exposure to every other major bank. If one fails to deliver physical metal on a contract, others must cover that delivery from their own reserves, which depletes their reserves, which makes them vulnerable to the next delivery demand, which creates a cascade. And here is the truly dangerous part. Central banks cannot simply print silver. They can create dollars, euros, yen, with keystrokes, but they cannot create physical metal. If a derivative crisis in silver triggers bank failures, the traditional rescue mechanism, liquidity injection, does not work. You cannot solve a physical delivery crisis with digital currency. This is why the silence from major institutions is so deafening. They are not silent because everything is fine. They are silent because they have no solution. The derivative time bomb is not theoretical. It is not a distant possibility. It is sitting on balance sheets right now, ticking. And the timer just accelerated. Because when silver crossed $80, it did not just break a price ceiling, it broke the assumption that paper and physical silver are the same thing. And once that assumption shatters, everything built upon it collapses. There's a factory in Bavaria. It produces high-efficiency solar panels, approximately 12,000 units per month. Each panel requires 20 grams of silver. At $60 per ounce, this represented a manageable input cost. The company had locked in supply contracts, hedged currency exposure, optimized their entire production model. Then silver hit $80. Within 72 hours, 3 of their 5 suppliers invoked force majeure clauses. Force majeure, the legal term that means extraordinary circumstances beyond our control. Translation: we cannot deliver what we promised. The factory now faces a choice: pay spot prices, which would eliminate their profit margin entirely, or halt production and breach contracts with customers across Europe. There is no third option. This is not a hypothetical scenario. This is happening right now across multiple industries on every continent. Silver is not gold. Gold is primarily a monetary metal, a store of value, a central bank reserve asset. But silver is industrial. Every smartphone contains between 1/3 and 1/2 gram of silver. Every electric vehicle uses between 25 to 50 grams. Solar panels, medical devices, water purification systems, RFID chips, satellites, all require silver, not as a luxury, but as a functional necessity. There is no substitute that matches silver's unique combination of electrical conductivity, thermal properties, and antibacterial characteristics, which means when silver prices spike, entire supply chains seize. Business leaders trained in traditional risk management are discovering their models are obsolete. They hedged currency risk. They diversified suppliers geographically. They maintained inventory buffers. But none of these strategies contemplated a scenario where the underlying commodity simply becomes unavailable at any price. And this is the strategic reality that $80 silver represents. The problem is not just cost. The problem is access. Major electronics manufacturers in South Korea are now pre-purchasing silver supplies 18 months in advance. Automotive companies in Germany are stockpiling silver alongside steel and semiconductors. Medical device producers in the United States are securing silver through long-term contracts that lock them into prices, regardless of spot market levels. This behavior is not normal procurement. This is crisis hoarding. And hoarding creates a self-reinforcing cycle. When companies stockpile a commodity, available supply decreases. Decreased supply drives prices higher. Higher prices trigger more hoarding. This is how shortages transform from temporary disruptions into structural crises. The business executives making these decisions are not irrational. They are responding to a simple calculation. Paying a premium today is cheaper than shutting down production tomorrow. Overpaying for silver at $90 is preferable to explaining to shareholders why manufacturing halted completely. But there is a deeper implication that extends beyond procurement strategies. The silver price shock is revealing something about the global financial system itself. For decades, businesses operated under an assumption. Markets are liquid. Commodities are available. Currencies are stable. Financial institutions are reliable. These were not questions. They were axioms, foundational truths upon which every business plan, every financial model, every growth strategy was built. $80 silver is challenging all of these axioms simultaneously. If silver can spike 40% in weeks, what else can? If suppliers can invoke force majeure on contracted deliveries, what contracts are actually binding? If major banks are going silent during a commodity crisis, what does that say about their stability? The strategic question is not, how do we manage higher silver prices? The strategic question is, what do we do when fundamental assumptions about market stability prove false? Consider the implications for capital structure. A manufacturing company carries debt, assuming stable input costs and reliable supply chains. When those assumptions break, debt becomes dangerous. Fixed obligations, meeting variable crises, is a formula for insolvency. Cash, once considered a drag on returns, suddenly becomes the most valuable asset, not for investment, but for survival. The ability to pay any price, to secure critical inputs, to outlast competitors who run out of liquidity. There's also the currency dimension. Silver hitting $80 is not just about silver, it is a referendum on fiat currency. When people flee into physical commodities at any price, they are voting that they trust tangible assets more than government promises. For businesses operating internationally, this creates a paradox. Revenues come in currencies that are losing purchasing power. Costs are denominated in commodities that are gaining value. The math stops working. Profit margins, calculated in depreciating currencies, become meaningless. A company can report record revenues in dollar terms, while simultaneously losing ground in real purchasing power. So what do business leaders do with this information? First, recognize that this is not a temporary disruption. The forces driving silver prices, monetary instability, geopolitical fragmentation, supply chain nationalism, are not reversing. Second, understand that counterparty risk has returned. For 20 years, businesses assumed their banks, suppliers, and customers would honor commitments. That assumption is now a liability. Diversification is no longer optional. Third, liquidity trumps optimization, lean inventory, just-in-time delivery, maximum efficiency. These strategies were designed for stable systems. In unstable systems, they are catastrophic. Redundancy, buffer stocks, and cash reserves. These are not inefficiencies anymore. They are insurance. The final implication is the hardest to accept. Business leaders must now operate, assuming financial system instability, not as a risk factor, but as a baseline condition. The world where central banks guaranteed liquidity, where governments ensured stability, where markets always cleared, that world is ending. The question is not whether your business can adapt. The question is whether you realize adaptation is necessary before your competitors do. Because in the environment that $80 silver has revealed, speed of recognition determines survival, and survival is no longer guaranteed.